So this is episode 1, season 1, episode 1 of Money Talks, the podcast, brought to you by Becoming Financially Fit. And so here at Becoming Financially Fit, we talk about personal finance, financial literacy, savings and investing. We also throw in some entrepreneurship as well. Episode 1, I'm here with Steven Nelson, aka Nelson. Nelson, how are you?
I'm good, man. How you doing?
Not bad. So Nelson, we've been friends for about 10 years now.
Yeah, what are we looking at? 2014?
2010.
2010. I'm thinking graduation year. 2010, basic training, yeah. So yeah, we're going on a decade.
Decade, yeah. That's crazy.
Fast.
So I met Nelson when I was at the U.S. Air Force Academy. We played football together. And so Nelson actually just finished up his stint in the Air Force.
Yeah, 5.5 years. Space operations and program management within space operations.
So tell us more about that. Like, what were you doing in the Air Force? Actually, we can start out just telling us about your background, and then we can kind of go into everything else.
Yeah, so most people know I'm a heavy Colorado rapper. I'm from Colorado. My family actually is from the Bronx, though. Both parents, they moved to Colorado because the Army stayed there. My dad got out. So from Colorado Springs specifically, which is 45 minutes south of Denver, went to the Air Force Academy. As you said, I got to spend play some football there. I was a business major, and when I graduated, they deemed me a space officer, which is a 13S. That's what they call 13S. And for the first 3.5 years, it was super cool. I was on the West Coast in Vandenberg Air Force Base, which people don't know is about 50 minutes to an hour north of Santa Barbara, California. Mm-hmm. Most people know Santa Barbara because that's Oprah's house. Santa Barbara is a really nice part of California. And I actually was doing a space launch, some of the coolest missions possible.
You were working with SpaceX?
SpaceX, the NSA satellites, anything of getting a rocket into space or a satellite into orbit. I compare it to, all the space movies as far as Apollo 13, those type missions, So I was working, I think I worked 6 missions, and actually was on the first mission that SpaceX from the Western Range launched the satellite into space and then landed the booster back onto a barge. That was the first time they ever did it on the western part of the United States. So that was a historic mission. Elon Musk actually came to the base, flew in on his private jet, whole nine. So I did that for 3.5 years. Then I moved to Los Angeles, where I started doing the program management side of the space stuff. So, looking at acquisitions of the rockets or potential acquisitions of satellite ground systems. And so I did that for 1.5 years. And then I just got out August 30th, last year, 2019. So I'm full-blown civilian now.
Full-blown civilian.
Yeah.
So when you first got into investing, is this something that your parents taught you? Or is it something that you kind of learned along the way? Because I know I first started investing in about 2010, 2011. So when did you start your investing journey?
I started my investing journey actually in 2012. My parents didn't have a lot of money, if you will. And so they gave me all the soft skills I needed as far as character, discipline, being an honest person, respect, all the character traits that you'd want. But they probably were learning on their own. So I still teach my parents to this day about long-term investing and, just simple things like that. But I first started investing at the Air Force Academy when they gave me the career starter loan. It was basically $36,000 at 0.075% interest. So basically,
that's available
free
to all cadets.
All cadets from all the service academies. It's basically no interest loan, if you will. it's barely any interest at all. Took that, and this is when I was a rookie. When I mean a rookie in investing, got the money, bought a car, and then
depreciating asset.
Put the rims on the Charger, had a system in it, literally bought a grill from the front, the whole nine. This is 21-year-old me. But then I went to the advisors at the bank, and we now that I look back at it, I don't even know why they were paying the people who were telling me what to do. They literally look at a risk chart of what you say your risk is, and then they go, oh, put your money in there. That's all. That's why there's the increase of robo-advisors now, because you honestly don't. I can just tell you this is my risk.
Because you can do that same survey by yourself, essentially.
And it'll just spit out, this is the fund you should go to based on your risk tolerance. That's essentially what they did. So this is 2012, post-market crash, 3 years post-market crash, if you will, however you want to time it. And then just put my money into an index fund, mutual funds, S&P, following the S&P, and that's all I was doing.
Do you invest in individual stocks right now, or mainly just mutual funds, ETFs, things like that?
Right now, since I'm back to being a student, I do some individual stocks and just index tracking and short-term trade. So I kind of mix all three.
Okay. And what platform do you use when you trade? Because there has been a rise, like you said, of some robo-advisors like Robinhood, M1 Finance, things that you can go outside of the traditional like Vanguard or Charles Schwab, that space. So what platform do you use?
I use TD Ameritrade. Okay. And if everyone doesn't know, TD Ameritrade actually cut off fees for equity trades.
Yes,
earlier this year, stock fell the whole 9. But it's a new wave of that going on.
Vanguard just did it, I want to say a couple of days ago as well.
I didn't even catch that.
$0 trades on stock trades, options, ETFs, their mutual funds as well. So I think we're the real winner of that whole fee war with discount brokers, right? Because now that Robinhood came out, right? And I talk a lot about Robinhood on the channel, but now that they came out with zero fee investing, everyone, that's like the standard now. Yeah. So before you could be charged $20 to get into a trade, $20 to get out to a trade.
It was horrible.
So if you're not really trading thousands of dollars, it really didn't make sense to invest. And that's what kind of discouraged a lot of people because they were saying
you need to make $40 minimum to break even.
Exactly. When you're only buying one share that costs maybe like $200 or buying a share of Apple, it's only going for $300. So you really can't make money, right?
Yeah. And so I think that's I think it should have been there, but again, I understand from the broker standpoint how they should make money, but the fees were outrageous. And now that there are the zero fees, I think people are putting more money into the market. It's an interesting world when you're looking at like how the stock market or how trading has gone or how investing has gone. Because you're right, if now I don't have any fees at all, I can just put money in there, and any gain is my gain.
Exactly.
Versus if I know I'm already at a loss of $40.
You have to plan so
Stocks
differently.
are slower. Stocks are slower than other equity classes or other asset classes. So you literally had to make $40 before you even broke even. That's kind of tough for some people to swallow.
I think it really is, and it kind of like
and minimums and account minimums. That's the big difference. A lot of people were hesitant to invest because they said some of the best returning funds, such as like, maybe you got your Vanguard top fund, S&P index fund, whatever, or your Fidelity or all those. They're like, you need to start with $10,000 minimum.
So we don't charge you money.
Yeah. So people, I don't have 10 grand to invest in an index fund. Now you have a lot of these funds. They're like, hey, $0, like you could put $5 in, $50,
exactly.
$1. No mins. That changed the game for a lot of people, which it's weird that this is just a new thing. I mean, probably within the past 3 years, $0 minimums have no minimum accounts have come to like fruition. But man, I remember when I was 22.
I was gonna say when I was trading, or when I first got into trading, like you had to pay either $7.95 or $13, sometimes even $19, just to get into a trade. So that means if I buy a stock, I'm already at a loss of $20.
Yep.
Right. And so if I want to get out of that stock, let's say the stock went down, I just want to cut my losses. Not only am I losing on the stock, but I'm also losing on the commission.
Yeah.
So now that we have zero fees, it's just great for the consumer.
Zero fees is great. No balance minimum is great. So it's just easier for the retail investor to get. I mean,
and when you say retail investor, you mean everyday investor like me and you. People that can just log onto their phone and start buying stocks, right?
A guy from delivering newspapers all the way up to like an investment banker. They all have the same opportunity as far as retail investing into any of these stocks.
Okay. And so now explain how you got into the real estate market. Right?
Yeah, it's interesting because I was very young. So I was 21 years old at the Air Force Academy. And like I said, I was just a finance guy. I loved the markets. I thought I knew what I was doing, but it was just index funds. Simple, just tracking the S&P. That's all I was doing. A few of my friends had a really small real estate LLC that they're still probably doing the paperwork for. Not even a purchase, first purchase is done yet, and they were just recruiting me through the summer. I remember like, man, we have our secretary, our president, the whole structure in place. We just don't have a CFO. I was like, cool, whatever. You guys got it. And then they threw it in the summer. And it's like, no, it's like you seem like the guy. Like we want someone like you to come on the team. I was like, man, I don't know. I'm making money. This is post 2009, so the market was giving me 15% a year. I'm just like, man, I'm just waking up, making money. And they're like, bro, like you really need to come on the team. So I was like, okay, what are we looking at? What's the future hold for this company? And basically, they sold me through the summer, and they're like, all right, now so you got to get on board. Obviously, you have to buy into the company. So I sold.
How much was your initial investment?
I think it was about $15,000.
Okay.
So all my money that I had, I sold all the mutual funds, wrote a check, put it into we did the documents with the lawyers and all that, and basically started LLC. And if anyone doesn't know, it sounds maybe more complex than it is, but.
Yeah, so you want to explain the process of LLC, and then we'll get back into the real estate?
Yeah, LLCs are pretty simple. Like, I've launched an LLC. You don't even have to have a lawyer in it. Or you need a lawyer, but you don't have to actually meet in an office. In person, yeah, you can literally, there's like, LLC generation in some states is $50. Mm-hmm. In Colorado, I think it's $50 when I started one. You just want a lawyer if you, in general, that's the safe practice. But like, if you think these companies will expand to these large horizons, you want to get the foundation sealed, locked in, things of that nature. And so that's what we did. We started with the LLC, got that whole thing modified, get it signed and sealed.
How many of you guys were initially in the
group?
Four guys.
All Air Force Academy guys. And we just started with a house. So we all had the $36,000 loan, right? Mm-hmm. First house purchase was $78,000. This is great.
$78,000 total?
Yeah, total. This is post-market crash, which is great because
this
all
the
houses
were
cheap. Correct, Colorado Springs. And I was a native, so I knew the city. I knew I understand the
That actually
land.
helps a lot to know the market.
It does. And so we bought this house. And I like to tell people this. Like, if you're getting into a new investment, get your feet wet. Don't try to go into real estate and buy a hotel if you don't know what a cap rate is.
Or a
if you don't know,
or a commercial building.
So you don't know about appraisals, refinancing, taking money out on gain of, appreciation for your real estate. You have to really get your feet wet. And so that's what we did. We bought a small, single family home, cash. Uh-huh. It was $78,000. We pulled our money again. We all had $36,000, and we all put a portion of our money in. Bought the house cash. Figured out what it was. Working with the bank. Buying a property through an LLC versus being an independent purchase.
Yes, because the process is a lot different.
It's a big difference. A bank took a chance on us just through relationships. It's like, okay, Air Force Academy guys.
It wasn't a traditional bank.
No, it was a local bank, Integrity Bank in Colorado Springs. And basically, they were like, all right, I trust these guys. These are cadets. They're going to be Air Force officers, steady stream of income going on. Everything's well. They trusted us because some LLCs, that's why it's called limited liability.
Exactly.
You can't take my assets. If this company goes belly up, you still can't take my assets. Now, if it's a sole proprietor,
then
you can take my assets. If I don't pay my mortgage, they legally can go in and take my money.
You personally.
Yes, because I'm a sole proprietor. LLC, it's limited.
So if you only had the house in the name of that LLC,
yeah.
If anything were to go bad, they could only get the house.
Business blows.
Yeah. But let's say you have $1 million on the side personally, they can't touch any of that if you put some of your assets in the LLC, correct?
Correct. Yeah, they can't.
That's what a lot of people don't know. So
yeah, that's why some banks are like, man, limited liability. I'm unsure. They took a stance on us. Granted, they did their due diligence. Mm-hmm. So back to going back to the surface. We bought the house, did all the basics. We worked with tenants, getting people in the house. We did a lot of, modifications. We cut part of a tree down. We fixed the gutters, and we worked with our tenant.
And so when you're doing this, you're a business owner now. Mm-hmm. So not only are you, a homeowner with the LLC, but you're a business owner. You have to deal with tenants. You have to do leases and things like that, mm-hmm. right?
And we did, of course. And you definitely want to make sure your tenants are up to your standards, if you will. And so we did all this throughout the years. And the one thing that makes the house appreciate long term was keeping a tenant in the house.
Exactly.
You want to have your vacancy rate, proper. You don't,
because if a tenant's not in the house, you're losing money. It's not as bad if you've bought the house outright, right, and you own it.
Yeah.
But if you are paying a mortgage or something like that, you still have to pay taxes. A lot of people don't know. If you own a home, you have to pay taxes on it. It doesn't matter if someone lives in it or doesn't. You have to pay insurance, because if you don't, then if anything happens to the house, you're liable. And a house costs a lot to rebuild, right?
Yeah, it does. And so, all the fees, you're right. Just even with that single family small home, you do have your property tax of Colorado and then your property insurance. Mm-hmm. So we did that. And just over the years, we just started modifying the house. Like, fix-up costs is what the basic thing. You just put in a lot of fix-up costs into it. So like I said, the gutters, we worked with the tenant actually he redid the kitchen on his own. It was cool. We'll cut your rent, by whatever percentage, I forgot the exact percentage, for the few months that he did. He literally was giving us receipts showing us this is how much we did, cut off his rent. And basically he was helping us upgrade the house.
You really don't find that.
No.
Okay.
It was an Army sergeant. So it worked. So he was fixing up the house, so by the time he left, we had, new kitchen, kitchen interior, gutters redone, the tree cut down a little bit or trimmed, and the house just kept appreciating. We did a reappraisal, and then before you know it, was like, oh wow, your house appreciated $40,000.
When you did the reappraisal, did you just use like an online site like Zillow? Or did
you actually have to go to a bank, because we did a reappraisal because we wanted money to take money out the house.
Okay.
So basically, the bank will go in there and
to get the equity out of the house.
Yep.
Okay.
The bank will say, they'll send their appraiser and say, man, yeah, this house is worth the $78,000 they bought. It's worth $120 now. Mm-hmm. Okay, cool. Well, you have to keep an equity level that they're safe with.
It's usually about 80% to 90%, depending on the bank.
Mm-hmm. And so then they say, okay, we're comfortable giving you $35,000 out of this. Cool. And so you do things like that. And so eventually we just held that. And then when we sold it, major gain. You got to remember, we held this house for about, maybe 4 years, right? House appreciated crazy, like 78 grand cash, right?
What year did you buy the house?
2013. Pretty sure it's 2012 or 2013. I can't remember the exact date.
Right when the market was, trying to get out of that low of the financial crisis, home prices were still super low, because I did purchase around that same time.
Yeah.
Right?
And so I think when we eventually sold it, it went for like $225,000. Something crazy. Like if I have my statements in front of me, I'll give you an exact number, but it went for something where we pulled out so much capital, we actually went and switched like real estate classes and went to apartments. Yeah. Because the next purchase was a 7-unit apartment in Colorado Springs, downtown Colorado Springs, and that was going for $300,000.
Which is, once you get from 1 to 4 units, is still considered residential. Yeah. Once you get 5 units plus, that's considered commercial. So you jumped from a single family home right into the commercial business, right?
Went up to the ladder, climbed the ladder quick, and so we did that. It was $300,000. Again, mortgage, the whole nine. And if I recall, I think we had to put up $100,000 of it. Put $100,000 up. Granted, like I said, we had the sale. Then we had money in our bank account just for
from rent,
networking capital, the whole nine. And then bought the house or bought that apartment. Same thing. Renovated the bottom. We put, I think, $15,000 of fix-up costs. Fixed some of the sidewalk. Also, the sidewalks actually are state owned, and so they have to fix it
no matter what.
Yeah, well, hey, these sidewalks are cracked. The state has to fix it. So we got to fix like our driveway path, the basements, if you will, put storage in it, repainted it, gutters, the whole nine, right? New tenants.
And is this something you did up front to kind of like
you go throughout it, because a lot of people won't just have the $10,000. You might need to save it up or from the rent, excess rent, whatever. So we put the money in. We just held that. Like I said, I think we kept around all 7 units occupied for the years that we held it. And around in 2000, we had that in 2014.
You purchased in 2014. Okay.
That apartment building. And then we recently actually sold it about 2.5 years ago. And this is the biggest sale we ever had. So we bought it for $300,000, right? With $100,000 on it. Some, investor came and said, hey man, it's time for our broker basically like, hey man, you might get a lot on this unit, and we had the potential to buy.
Your broker came to you. You guys didn't market it.
Yeah. Nope. The broker came to me, and we were looking at retail now. So then, or retail centers, and so then the guy was like, hey man, you might want to start looking for offers. And so the one guy came and was like, hey, I'll give you $450,000 right now. He wanted to use credit though. We was like, okay, whatever. Another guy came for about $435,440. I wish I had my exact numbers on it. He's like, I'm gonna pay cash though.
Wow.
I'll just write the check. Older gentleman, wealthier gentleman. He said, I don't even want it for anything else except my daughters. I was like, how many daughters you got? It's 7 units. I was like, well, we want that because we don't have to work at the banks now.
It's always good. If they come with a cash offer and they're willing to close within, how long does it take to close? 30 days max?
Yeah, quick. Yep. And so before you know, I'm like, oh, we already had $100,000 in it. just made about $140,000 or $135,000 on the gain of sale. We have almost $250,000
free cash
in cash,
yeah, ready
right?
to go, ready for the next investment.
Tax law: if you don't, you have 180 days, 6 months to redeploy the capital without taking capital gains tax.
Exactly.
So we're sitting back. Okay, we don't want to take this 25% tax hit. We had the retail center. That was the next big thing.
The retail center is a strip mall type deal.
Yeah, 4 units, retail center, and land that was attached to it. So this is the big jump for us because this will be now our first 7-figure property. Mm-hmm. So okay, let's jump. We took the jump. 7-figure unit. Ended up costing us $1.3 million. Big deal. We still have the picture.
What you guys put down on it? Like 25%?
The whole 200. And seller finance. So basically, the dude helped. The dude owned
so
it.
you didn't have
us.
to put down the full 20 to 25%. You could put down whatever.
Yeah, we put up $200,000. I think it was $200,000 of cash. Gave it to them, and so we worked on that. And so the same thing. Did a little bit of renovations on that. Retail centers are different. Mm-hmm. Those are specifically more. The value comes from keeping quality businesses inside those units.
What type of businesses do you have in there right now?
A restaurant, a Mexican restaurant, a flower shop, H&R Block. And then I think actually the restaurant covers 2 units actually.
Okay.
So I was like, cool. And then we had the acre of land attached to it. Mm-hmm. We actually are about to sell the acre of land though.
Really?
So, yeah. Okay. We're working on trying to build something on top of it. Honestly, that takes a lot of more, sweat, equity, capital.
You have to put a lot of money
and a lot of
into
us
that.
are kind of spread out. So we're like, hey man, let's sell the land. And it sucks because I really wish we could have renegotiated with the people who bought the land because they're buying the land to build on top. Uh-huh. I'm like, man, I wish we could have
leased it out to them.
Not even that. I would say hey, we'll sell you the land at a discount if you give me 10% of the new company or whatever building you're putting on top of this land. We didn't get to do it.
Didn't get the equity, but you sold it.
But we still got, we still made a decent profit. And I like using the real numbers because when I watch podcasts like this, people are like, make money by saving money. You're like, well, what the heck does that mean? So I want to show you the exact process that you did. So we bought this land for $100,000.
So this whole process was, you bought your first building in, let's say, 2012. Mm-hmm. Right now we're in 2020. Mm-hmm. You leveled up from a single family home to a 7-unit apartment building, all the way up to a retail shopping center, right? Within the matter of
8 years.
8 years, right? So it's definitely doable, right?
It's not hard. I don't think any of this is hard. I don't think investing's hard. Now, simple investing isn't hard. Mm-hmm. Once you get up to different levels, it takes way more discipline, way more research, more risk is involved. Risk is on all investments. When you get to certain things like day trade, options trading, futures trading, derivative trading, those are the things where you need to maybe really, practice and get some real reps in before. But buying a stock, I go on Apple, boom, bought a stock, bought Apple, bull market, whatever.
Exactly.
Cool.
I want to say I bought Apple 3 weeks ago for $270.
Quick.
$265. Now it's up to $3 something.
And you just, simple. Real estate. You have a steady stream of income. You have a good credit score. And I'm not trying to downplay those things because those are sometimes not as easily accessible for everyone. But get steady stream of income, good credit score. You go to the bank, you get something that's in your budget. Yep. I can afford $1,000 mortgage. Put the $1,000 because
and not to cut you off, but a lot of people don't know that you could pay less for a home if you own it than if you're renting, right? Because if you get a 30-year mortgage, what people usually do is get a 30-year mortgage, right? Yeah. And you go to the bank, you put some type of down payment down. It could be as low as 3.5%, 5%, something like this. And instead of paying, let's say, $1,500 to $2,000 for rent, you can actually pay, let's say, $700 for rent or your mortgage.
Our first house that we bought, when I first mentioned the $78,000 home, the rent we charged when we first got it was $1,250. The family that was in at $1,250. Our mortgage was $650.
And that's what a lot of people don't know, right?
$650 was our mortgage, and we're charging them $1,250. Next year, rent increase. Then when we refinanced the house, mortgage was $800.
And you're still making.
I'm charging 10 to 15. 17, and you're just the margin was great. Mm-hmm. Granted, again, for new investors in real estate, I think you have to just worry about making some cash flow. Because there is a difference from cash flow real estate and value real estate. Value real estate is I want to buy a penthouse in Manhattan. I'm not going to make money on it. I'm going to break even.
Yep.
But in 10 years, this penthouse is going to be worth $10 million. I bought it for $1 million.
Exactly.
San Francisco, Austin, those things like that. But I'm not making money. That's for people who are more seasoned, the cash flow, they have reserves
and they
ready.
can actually have that money sitting, right? It's kind of like their version of a CD, but hyper accelerated, right?
Exactly.
They have their money sitting into a specific investment vehicle, right?
Yeah.
And they just let it sit there. They don't need to touch that $1 million. It could be something that, let's say, they give to their kids, right?
Yeah.
Let's say, hey, their kids are around like 10 to 12. And they say, hey, when you graduate college, this is going to be yours. I'm going to put $1 million into it. And like you said, over the course of 10 years, that $1 million could be worth $5-10 million, depending on the location and the market at the time, right?
Man, you hear those stories of the grandparents and the families, and like they say, man, I at least have this home. Because you got to think, if your grandparents or your parents, they bought a house when they're in their 20s, 30-year mortgage, they have an asset that's worth 100 and something, 200 and something. Like my wife's parents, they bought a house in Colorado Springs, and obviously it's not been 30 years since they bought it, but it's pretty close. And I look back, like I know the house is appreciated, and when the 30-year hit, it's all theirs, the whole home,
that whole entire asset.
I'm like, man, that's $200,000 in cash if they ever wanted, you know, or just, hey, this is yours, pass it down to the kids. And so it's great. And so back to what I was originally saying about the retail center with the land. I'm gonna get back to like purchasing homes for like people who are just starting. The land, $100,000, that's what it came for. We're sure about to sell it for like about 180. So that's great. So like, this is land. There's nothing on it.
You're a landowner.
But it's right next to the Air Force Academy. So we're about to make that sale it's about to close in I think 2 weeks.
Okay. All right. So Nelson, let's talk about generational wealth.
Yeah.
Right? Because you were discussing, your parents or grandparents, how they could buy something a long time ago, and it passes through the generation. So you want to talk a little bit about that right now?
Yeah. So first things first, I will say, as a 29-year-old guy, I'm still building it myself. So I'm not the I guess the best case study, but I will say I could be a case study of someone who's trying to keep building it, And so when you're looking at generational wealth, you're looking at something. Let's just break down generation. Something I'm passing on to the next generation of my, of my kids or my grandkids, and a lot of it just starts with pure assets. Even if your portfolio is not making money, even if the stock market's going down, you still should. Whenever your kids, have that time frame of when it's time for them to start investing or them start to build a family, you want to have their floor higher than yours.
Exactly.
Like I call it, coming from our community, like getting it from the mud. I came from the mud when it comes to money. Like we didn't have any money growing up. Like literally broke. I worked at Taco Bell at 14. You know what I'm saying? Like, so I was really in it.
And that's crazy from where you are then to where you are now, right?
Literally zero money. I mean, like, hey, mom, basketball season's coming. I don't have money for shoes. Like literally that type of money. We don't, so it's better now. But generational wealth, my biggest thing is this. It's hard, but it's not really hard if you take it in steps. For example, I don't know if people know this, what a 529B account is. A 529B account is an education account for children that is not taxed, because if it's redeployed for educational purposes, government's okay with that. You can start a 529B account the day your child is born. In the hospital, they pop out the womb. I'm going to the bank. I want a 529B account on the spot.
I'll do you one better. You can start a 529 plan right now, put it under your name. When your kid is born, you can switch who the account owner is to your kid's name.
Exactly.
So a lot of people think that they can only save for 18 years before the kid goes to college, but I already have one opened up in my name right now that I'm putting money in every month. And as soon as I have a kid, I can switch the account owner from my name to their name, and now they are the owner. So not only do they get the benefit of having me saving for 18 years, but they get that additional years too, because I don't have any children yet.
Let me ask you a question. When you were 18, how would $30,000 benefited you?
If I was 18?
When you were 18, $30,000, how would it benefited you?
I honestly, I didn't know what I didn't know, right? I didn't know how to invest. I didn't know how to save. I barely knew how to save, right? I just knew that $30,000 was money. I can go spend it. I would probably buy a car because I didn't have a nice car at the time, right? I was just going off to college. I really didn't have that much, right? When I think about $30,000 then versus how it is now, it's completely different, because now I know that $30,000 can be used to generate me thousands of dollars in the future, right?
Let me ask it in this context. How will your future kid feel about $30,000 at 18? And I'm getting to somewhere.
Yeah. So my future kid, right? I'm gonna try at least to impart the knowledge to them that says, that $30,000 is not just cash to spend, right? It's cash to make you money for the rest of your life.
And the reason I'm asking this is I'm trying to break it down in simplest context. That 529B account, you could put $20 in it for 18 years. Even if the kid gets 10 grand, 15 grand, these are $20. You could just keep putting in. 20 years of compounding interest, that kid could maybe have 10 grand. Now we say, I'll put 1,000 in it for 20 years. Now your kid's graduating at 18 years old with $200,000. His college paid for cash. That's what I'm trying to get at. Like 20 years of compounding interest. Even if you was like, man, I only could put $20 in my kid's account. Still, that $20 changed their life
over time. Exactly. Because if you're doing consistently $20, obviously over the course of 18 years, you can increase that. But if you consistently do it every single month with compound interest, a lot of people don't know about compound interest, but that means if you put money up front, your money makes you money every month, every year, right? And so if you put that up front over the course of 18 years or 20 years, 25 years, by the time your kid is 18 or they're 22 and they're just graduating either high school or college, you have that money set aside for them that says, hey, you can use this, let's say $100,000, $200,000 for your college, or if you don't want to go to college, you know what? This is yours.
And on the Fund 29B account, it's if they don't use it for education, it's taxed, but it's still cash. Like at the end of the day, like, man, I take 25% hit on it. I still get 75% of it. You know? But like back to the topic of generational wealth, even if the kid, like they literally are going to go to college for free. Now they're 22, college degrees. They have no debt at 22 with the college degree. They can now see the world in a different lens instead of, man, I got to go work. And like,
they don't have to think about, oh, I have loans or I need to pay for this or how am I going to do this?
I got to take a job I hate because I have to pay the loan down.
Exactly. So now what do you think about the whole, and this is a topic that a lot of people are talking about lately, working from the point when you're like 20 up until 65 and then retiring with $1 million in a retirement. What do you think about that whole scheme, I would call it?
It's unique because I sometimes get philosophical about some of these topics, like, because I think every human is different, but I'm not with it. Me, I hate it. I just don't like the concept. I don't like the concept of being in the machine, the revolving door, like work, 65. No, I need $1 million at 33. I'm not doing 65 years old. I just don't believe in that concept. For me, some people though, they're cool with just, I want to work in a company for 25 years. I want a house. I want to sit in my backyard and drink whiskey on Saturdays. I want to barbecue, and I'm fine with that. So everyone's not going to want the mindset of, man, I want to take trips to the Maldives Islands with my kids. I want to go to, I want to have brunch in Greece. Like some people are okay with the concept of, I just want to save a little. I just want to make sure my kids got a little money here.
And there's nothing wrong with either.
I want to buy my Honda
side, right?
Civic, and it's no problem with either or. So I think it comes down to just like whatever you want in your life. I know why I want a lot of money, and it's maybe not even just like for myself. It's what I can actually change in the world. So like I gotta reach for those goals. And at the end of the day, I also do like some things that cost more. I like watches. I like cars. I like things like that. I like trips to islands, and that's fun. But some people are just okay with, working 60, 65 and having $1 million in cash. Because you got to remember, that was the normality, and it still is.
For our parents.
Or
our
grandparents. You work in Detroit, you working at the Ford factory, you worked there for 30 years, you got your pension, you're good, and you bought your house, life's fine.
Yeah.
And a lot of these current billionaires, actually, those were their parents. A lot of industrial people, they were like, hey, their parents worked there, gave them a solid base, they took it to the next level, So I think it just depended on the person.
And so now let me ask you this question, and this might resonate with a lot of people, but a lot of people think that $1 million is a lot. What do you think?
Are we talking about $1 million in cash?
$1 million in cash.
So it's interesting. So $1 million in cash.
In New York.
Oh, no. New York, no. And like I said, it's so subjective because if you have $1 million in cash, I got to see the person. Do you have any debt? Mm-hmm. Do you have any obligations? If I have $1 million in cash off a safe investment return, when I say safe, I mean, everything's risky, about, 3% a year. So you can potentially live off that just off the
interest.
The interest, mm-hmm. right? But I honestly think it's not generational at all.
Definitely.
Like $1 million, if you're not working and you're doing it, you just have $1 million lump sum. That's not generational, but it is a good aspiration. We look at it. I know I've talked to a few people about this. everyone's reaching for high numbers, which is great. Reach for the stars, land on the cloud. But $1 million, most people in America don't make $400,000. I think it's like the stat was 99% of the United States doesn't make $400,000.
And also, I want to say it was like 40% of people couldn't afford an expense that was $400.
Yeah, so you're like, if I got $1 million, I'm richer than the country almost. And so but what we're talking about, I want people to reach as far as possible. I want 10 million. So then if I land super short, at least I got 900 grand, so that concept. But yeah, $1 million in New York is not a lot, especially if you have any debts. Now, if you're a debtless person, you're living fine, $1 million could do you well.
Okay. And so what is your 5-year plan?
Oh yeah, so
because right now you recently got out of the Air Force.
Yep.
You're doing your MBA at Columbia. So I want to talk about a little bit about Columbia, your whole process of getting out of the Air Force and into Columbia.
Yeah.
And then after that, we can talk about that 5-year plan. So how did you actually go from being an officer, a captain in the Air Force, to being a first-year MBA student at Columbia, an Ivy League school?
First things first, shout out Columbia Business School.
CBS.
The Lions. And so I knew I was going to go to school eventually. I didn't know the time frame at all. Because I was actually interning at Bank of America this summer in Midtown. And so I had that option to go work there. But then I did
Midtown Manhattan?
Yeah, Midtown Manhattan.
And talk about that a little bit. What were you doing at Bank of America? How did you get into that program?
It's very competitive. It's called the Veterans Associate Program. Basically, they bring you in as an associate at the bank. I got an offer for the equity synthetic and security lendings team. Basically, it's just like a derivative trading desk. It was a great job.
What was the base salary for that? Just so people know that if you're going into a bank in Manhattan, this is how much you would make if you were at an associate position.
For an associate who didn't have an MBA, I was getting $125,000 base. Mm-hmm. And
if you have an MBA?
Depending on the role as well, it'll be like $150,000 a year. And so that was that. But I got into Columbia, got a scholarship.
So you turned down that $150,000?
Oh, 125. Yeah.
So you turned down $125 or $125,000, right?
Yeah.
To invest in your future.
Yeah.
Right. Because a lot of people wouldn't do that if they had 125 bands on the table.
And like I said, it's independent of each person.
Plus the signing bonus. We didn't even talk about that.
Yeah. And so I knew so I guess this is going to turn back to Columbia, my end goal. My end goal is to own my own investment firm. Mm-hmm. Case closed. I want my own investment firm.
Hedge fund or PE?
Probably a hedge fund, not like potentially PE. You never know, but I know I want to be. Actually, I'd say multi-strategy firm where I want to have real estate, equities, forex, alts. I want to run, Nelson Investments Co. Right, or the Nelson Investment brand, whatever. And so we'll figure that name out. But that's always been the plan, and it's going to be in Colorado. Mm-hmm. That's the plan. So I looked in
the Colorado Springs or Denver.
Denver, definitely Denver.
Okay.
So I looked in the future. I was like, okay, what is going to best suit me to get that plan? Working at a bank and a trading desk, probably not. Air Force Academy, officer, Columbia Business School. Some of the best investors of all time come from the school. Warren Buffett, or you have Robert Smith, who's from Colorado, the richest African American in the United States. He's richer than Oprah. And then so I was like, okay, well, with the lineage path, I need to go that. The pool of people I'm just in school with, and then the people I can talk to. Networking with. Hey, I'm a Columbia grad too.
And not just networking just to build clout or status, but networking to actually build relationships with these people, because these people are from all over the world. They have different things to offer, right?
My class is 45% international students. I remember my first day of school, I was talking to a guy. He had a red iPhone, and he had stickers on his still. I was like, hey, what's up, man? You look kind of lost. He was like, yeah, my first day in the United States was yesterday.
Wow.
I was like, oh, wow. So, that's the type of experience I'm getting. But back to the plan, I knew that I wanted to be I wanted to own my own firm, so I backdated it. And 10 years out, backdated. What's the best that's going to suit me? Going to school, and back to the question of the 5-year plan, I wanted to, for the first few years, I wanted to be an investment analyst. I wanted to really rip companies apart, investments apart, because I know that's the core skill you need regardless. Mm-hmm. And so that's why I went to Columbia, because I know my future plan is to own my own firm. But to start there is the art. That is the art of investors. You got some of the best of all time come there.
Okay. And so you also, we talk about investing. You talk about you do want to start a firm, Nelson Investments. Obviously, you're working on the name.
Yeah, need the name.
But what you do now is you do Forex trading.
I do a lot of trading. FX was the core of more how I started trading. But yeah, all the assets now.
And a lot of people, when they think about Forex, they think it's a scam.
Yeah, I don't know where that
because
came.
there's a lot of people online that are saying, hey, I can turn your $500 into $5,000, right? Can you actually explain how Forex trading works for a professional trader like yourself who's licensed?
First things first, all that Instagram stuff is a scam. I'm going to just lay it out right now. Like that, I look at my phone, that's all a scam. I'll let you know that right now. And if they tell you any different, you're getting lied to. Yeah. So like, that's the disclaimer. 2, professional traders, we're licensed. I have a Series 3, a Series 30, and a Series 34. Me and my partner, business partner, Michael Sutler, he runs SC Capital Management. It's an official licensed, we took FINRA exams, licensed with the, not the SEC, I'm sorry, the organization who it is, but it's licensed. We're good. Like official investors, lawyers, accountants, the whole nine. This isn't any like scamish things. We are, you have to study macroeconomic data. You have to understand what changes currency prices. So when people say, oh man, like, the trade war, the dollar's stronger, the euro's weaker, what's going on with Brexit, manufacturing PMI, inflation, all these things we have to study and see how the price of a currency changes. It's based on the value of dollars. We make money off the difference in the exchange rates. They go up and down all the time. For example, this week alone, I was trading the Great British Pound, which is third currency, versus Australian dollar. I thought the Australian dollar is going to weaken because the gold prices and how China was working that week, and I thought pound was increasing, and I based that off the dollar strength. And I know that maybe sound a little more complex than it is, but
you have a course that you're doing. You can kind of explain this, right?
Yeah, I do. I haven't taught the course because I've been in school recently, but it's a Saturday study where I explain all of how to trade and how those things that sort. But basically, I did that, and I made 120 pips on that trade. 120 pips, you look at how many points, how much per pip is. Great British Pound and Aussie is about $7 a pip, so you guys could do the math. You can make, and then depending on how much of that you buy, you can make anything from $300 on that trade to $30,000 on that trade, just depending on how much you put in. But yeah, it's basically macroeconomic data. You look at how these currencies are changing, how these countries are strengthening or weakening, and you make money on the exchange.
Okay.
And that was the base of how I traded. I trade everything: options, futures.
And how'd you learn how to trade?
From Michael Sutler. Yeah, he taught me the whole ropes, and then just reps. You could get paper accounts. Paper accounts are just like no real equity. They give you fake money, if you will. And I practiced for years. It took me 2 years to learn how to not lose money consistently. I still lose money,
exactly.
But like consistent losing money, it took me about 2 years just to figure out how to get base.
And what a lot of people I think they're fearful of is losing money, right?
Yeah.
But that actually, if you invest over time, you're going to lose money. That's just the facts, right? On certain trades, you will lose money, but if you invest consistently over a period of time, you'll more than likely come out, right? And so what I try to tell people a lot of the time is just put your money in. Start investing right today. A lot of people don't even invest at all. Like just buy your first stock. I have these conversations with my parents, right? And I just say, hey, you're going to be coming up on retirement. Like, what's your plan? Like, how can we do this? And, I tell them about stocks, ask them these things. And a lot of people don't know. A lot of people are just so scared. They don't even take the first step to investing or budgeting or planning out their finances.
And I think this is the topic we need to address right now that you just mentioned. It's called risk capital. Your risk capital is different for each person. For someone watching this podcast, it could be $50. When it means risk capital, and don't do this, I can look at this $100 bill, crumble it up, throw it away. It hurts a little bit, and I walk away. It doesn't fully bother me. I lost it. My rent will still be paid. My wife will still have her, her food on the table, the whole nine. If you can't do that with that money, don't invest it, because that is if your psyche's not right about the money that you're going to lose, that's why people are scared to invest. Don't invest more than you can lose. Do not leverage more than you can lose.
It can go to zero.
If I lost my entire trading account, I still would pay my phone bill. I still would pay my life insurance. I still would pay my car insurance, and I'd be okay. And your risk capital, even if it's $50, Robinhood's free now.
Exactly.
Put the $50 in a small cap growth stock that's trading at $12. Put it in an index fund, like an index fund where you can still track the S&P, but they're only trading for $11. You're not going to get an Amazon stock, but you can still start with that. And if you lose that 50, you don't even lose any sleep. That's the difference. Do not invest more than you can lose. Then at that point, your psyche changes, because then losing the money, you're like, sucks, but I'm okay.
And what I would recommend as well is automating your investing, automating your savings, right? If you get paid every 2 weeks, like a lot of people do, or every second Friday or something like that, what I would recommend for a lot of people is to put 5 to 10% from your check that goes directly into a dedicated either investing or savings account, right?
Yeah.
And so what happens over the period of time is you kind of forget about that money. And like you were saying, your risk capital, that money can be used to save or invest.
Yep.
And over a period of, let's say, a year, 6 months to 2 years or something like that, you'll start to see that now that you're only investing, let's say 5 to 10% of your income that's coming in every 2 weeks, now that's built up to a couple $1,000s. And now that can be used for things like a down payment on a home or to invest over time.
It's funny you mentioned that about automated investing because the Air Force introduced that my final 2 years, and they had the matching plan as well. We're like, hey, you could put up to 5%, and we'll match up to. You put as much you want, but we're matching up to 5%.
Yep.
I put the 5, so now 10% basically of my check was going in. I did it on a raise. What I mean by that is like when I promoted, I was like, okay, I was at a comfortable living level. So then I was okay. The raise, I needed it obviously, but I didn't need it for anything to like change my lifestyle. So I was like, hey, take the 5% and match it. So I wasn't even looking. I was tracking. I got the Air Force, looked at my investment account. Oh dang, I got $10,000. It was just growing on the side. I didn't even see it coming out. And so then I sit back like, wow, it's easier to do on a raise. I'll be honest. Like if you get your annual raise and you're at a comfortable living level, just take the raise and put it in there.
Exactly.
Like just don't even look at it because some people see as a raise as a reason to increase their cost, their lifestyle
spending. Definitely,
everyone is gonna have their lifestyle level, and you'll find it. You'll know, and then you'll know when you're going over it as well. So like just find that comfortable one, and everything excess of that, just put it in. Just don't even.
How would you find yours now that you're adjusting to living in Manhattan?
I would say it's a little different for me because I'm a student, but I would say you just find it comfortable where you're like, okay, I can eat my dinners, I can go out with my wife a little bit, I can get my groceries. You'll find it where you feel comfortable and you're not doing anything way outside your means. Like I'm not going to, just get these. I'm not going to Noble every weekend. You know? But again, that potential will change as you start growing. And I'm not saying, oh, now I make $1 million, go eat at McDonald's still, but I mean. You will find a personal comfort level where like, okay, I'm extremely happy with this. Everything excess I can invest in.
And what I see with a lot of people like yourself, Nelson, or people that have a different mindset, business investing mindset, is that they set certain goals for themselves. Yeah. Right?
Oh yeah.
And these goals are not just regular goals. Not like saying, hey, I want to save $1,000 for the year. It's saying, hey, I want to make $1 million within the next 5 years.
Yeah.
When you think about setting goals, how do you go about that process? And if you could name 1 or 2 goals that you have upcoming within either the next year or 5 years.
Actually, it's funny. I did my 2020 goals beginning of the year, top of the year. I break down, I make them reasonable. So I do a daily, a weekly, a monthly, quarterly, and that quarterly adds up to the year. And I do that at the top of the year. And then the 5 to 10 year goals are there, but those modify. So you can't really project 10 years of your life. So my daily goal is I want to meditate or pray for 15 minutes a day. That's just me.
Usually in the morning or at night?
Morning for sure. And sometimes at night before I go to sleep, whatever. That's like my daily goal. Then my weekly goals are like I want to try to get 4 workouts a week. And these are like things you should be close to attaining if you don't. So my last year goal was five days of working out a week. Didn't make it. It was just too inconsistent. I was like, I'm not going to reach that. So we'll do 4. And then you have like, I set those early so I make sure that they're smart goals and attainable the whole 9. And I just go out throughout the year, come back to them and see if it's working out, I can potentially modify them. But yeah, at the top of the year, I set them for daily, weekly, monthly, quarterly.
Okay. And what are some of your goals for 2020?
I wish I had my book. I actually have it. So like I said, one of my goals, I'm actually just going to read them to you because I took a picture of it. Yeah, it's right here. So we have my daily, like I said, is meditate for 15 minutes a day, drink half my body weight of water, and have a green meal a day. A green meal, I want to even salad basically. That keeps me right. Yeah, so a green meal a day. Weekly, like I said, work out 4 times a week. I work out in the mornings around 6 a.m. Try to eat out only 1 dinner and 1 brunch a week. Because in New York, it could be every day. Like you ate out 4 times, now I'm $400 deep. Talk to my family once a week because, as life goes, you try to talk to my parents.
A lot of people forget about that, but they keep you grounded.
Yeah, talk to the fam once a week. Monthly, read a book a month.
Do you have any book picks for us?
Right now, I'm reading Value Investing, The Art of Value Investing. It's a Columbia book. I would be hesitant on people I want to tell people be hesitant on reading pure finance because you still you need to be grounded. So my goal is 9 finance books and 3 philosophy books. Okay. Just because, I want to, and I split it,
And you have to switch it up because if you're reading strictly finance, it's going to get boring. It's not going to all, digest. So what I try to do is I read, like you said, 1 finance book or maybe 2 in a row. Then I switch it up and I read something completely different.
Yeah. Harry Potter book, anything, just just read.
Switch it up a little bit, yeah.
Monthly, like I said, I always read a book and then I want to try to make $10,000 a month off trading.
Have you hit that goal yet?
No. But I think with this new asset class, I have more money to trade now and more time.
Yeah.
So I think we'll see that's a new goal for me because it used to be $5K and I've done that before. And so we'll see how that goes. And quarterly is reevaluate just my portfolio, see how things are going. And for me as a student, I want to make sure my summer internships lined up. And I'm traveling to Africa in March, back to the motherland.
The motherland.
The motherland.
Have you ever been?
No, it'll be my first time in Africa, so I'm really excited.
Okay. Well, just wrapping up everything, Nelson, thank you for being on episode 1 of Money Talks with Becoming Financially Fit. I really did appreciate you coming on and giving us some insights about not only your background, investing in real estate, the stock market, everything like that, setting goals, but this has been great. So what I'm going to do is I'm going to put this out on all streaming platforms. We're also going to make a video on YouTube as well. So if you guys are listening in, you can check that out on either YouTube. You can follow us at Becoming Financially Fit on all social media platforms. And Nelson, do you want to give some of your socials as well?
Yeah. So you saw my social media?
Yeah.
My Instagram is Nelly Nell 19. That's typically what I use. I don't really use any other platform. But I just do want to send a closing note, don't let this investing stuff scare you. Just really just do it. I know real estate might be hard to get into, but buy a stock. Just get into it. It's just, I tell people if you want to learn how to swim, get pushed off into the water. Or did start on the 3 feet side of the pool. Just really just do it. Don't let the Wall Street Journal scare you and all these different things. In my investing, we do basic math.
Yeah.
I divide, multiply. Just get into the market. Don't be 20. Don't be 20 years from now. I'm like, man, I don't have anything in my portfolio.
No regrets.
Buy it, even at minimum. Buy a mutual fund. Just do something to make money for yourself, even if it's $25 a month.
Definitely, and there you have it.
Yeah.
From Stephen Nelson, aka Nelly Nell 19.
Nelly Nell 19. Yeah.
All right, thanks.
All right, man.